As always, it's a pleasure and a privilege to be here. Every time I come here, I learn a lot. And given that it's already been late for you, so I'll jump straight into the subject. How many of you have read the book Atlas Shrugged by Ayn Rand? Okay. So would anybody like to quickly summarize the story of Atlas Shrugged?
Sure, the premise in the story is about what's happening in society when government is taking away choice and liberty and beginning to control business a lot. And the idea is actually that the world works and countries work because of the people that produce and are working with a lot of internal integrity. And what happens in this is that the people that are producing decide to go on strike and say, you know what, we're going to go away. We're going to leave you to your own ideas and let the people decide. And what happens after that?
Right. So the one phrase which I would like you to focus on is where the wheels of the economy grind to a halt in that book, okay, for various reasons. But why the title Atlas Shrugged? Does anybody know that? It's on the Greek god Atlas, who carries the world on his shoulder. So if he shrugs, the world falls off. That's the concept. Okay? How does that apply here? Okay, we'll see. So flashback to August 2013, India was coming out of the moribund growth years, then absolute majority for Achhe Din campaign, a majority government after 30 years, aspiration for a scam and corruption free economy, global financial steroids continue, stable rupee, RBI hawks and commodity crack aiding lower inflation. India amongst best performing EMs, RBI focus on reserve accretion. Does anybody know how much reserve accretion has happened since then? A little over $30 billion after covering for the $30 billion of swaps. Yeah? So that's in all 60 billion. Sincere attempt to debottleneck key sectors, oil deregulation, GST land acquisition in various stages of progress, some initiatives like Jan Dhan, DBT, collective insurance, etc. Yet, economy is not responding. This is probably the third or the fourth quarter in a row where earnings have been downgraded. Earnings have disappointed. And market is now revisiting assumptions. Would most of you agree with this picture? Okay. So here, corporate earnings as a percentage of GDP in India are at their lowest since 2004. Despite such a steep rupee depreciation in 2013, our exports are in negative growth territory. As a country and as a central bank, we have agreed on inflation targeting. There is a monetary policy framework agreement between the Government of India and the Reserve Bank, which says that inflation targeting is what we will do. And which inflation? CPI inflation. consumer price inflation, and this is the composition and this is how that CPI has been coming down. But as you will see, a very large part of the CPI increase is still driven by fuel and light. Okay, this is not the weight in the computation of CPI, it is the cause of the inflation. A very large part is still fuel and light. Sorry, it's green, no? Sorry, food and beverages. Yeah, you're right. So, what is happening? We all know GDP is equal to agricultural GDP plus manufacturing plus services, right? We know the composition as well. Services is the largest component, then manufacturing, then agriculture. Services growing at a faster pace and therefore becoming larger and larger share of the economy. What most of us don't know is GDP is also equal to C plus I plus G plus net exports, which is consumption plus investments plus government expenditure plus net exports. Okay, it's the same result. Consumption is high, is the largest component of our economy, then investments, then government expenditure. What are we hearing? That the capex cycle in India is not working, right? That's given as the largest reason. But it's probably not that, because if Indian GDP is not to grow, consumption, if it is growing at a rapid pace, then the GDP will grow because it is the largest component of GDP. Here we see manufacturing, the industrial production, very anemic, hugging the zero line. And this is the composition of growth that the government has officially put out. And remember that this is after the revision of the GDP methodology. Like 2 years ago, we did the revision of the CPI methodology. The government says that in 2014-15, manufacturing grew at 6.5%. This is index of industrial production also given out by the government, which does not show that it is growing at 6.5%. So there is some disconnect somewhere. We don't know. What is the global picture? The financial steroids that we talked about. This is a list of all the financial steroids, and it continues. No point in getting into this, but every central bank in the world is pursuing what is known as easy monetary policy, or ultra easy monetary policy actually. Unprecedented, unconventional monetary policy. That ultra easy monetary policy is reflected in financial conditions. This is the financial conditions index for US, Europe and Asia ex Japan. Financial conditions worsened during global financial crisis, but strategic action, committed action by the central banks and by the governments brought them back, not just in the US, also in Europe and so on. Later on during the presentation, I will show you the Indian Financial Conditions Index as well. It's a methodology developed by Bloomberg they measure certain variables and from different components of the financial and markets, financial system and markets, and then derive this. You can go to Bloomberg and get the breakup. What you are seeing is that the financial conditions index today is actually better than what they were at the beginning of 2007-8 in the US. The balance sheets have expanded so dramatically from $6.5 trillion to almost $11 trillion. A lot of people talk about a lot of global clouds that can result in a storm. Greece with a debt to GDP of 180%, but China has a debt to GDP of 250% plus. China margin debt going up as if there is no tomorrow. Chinese margin debt as a percentage of China's free float market cap is 8.5% plus, which is 2.5% for US, with a much deeper market. Yeah. When you buy shares, if you pay 40 rupees and the broker funds you 60 rupees, then that's margin debt. The 60 rupees is the margin debt. Chinese valuations are back in high territory, but this one particular index, which is Chinese mid-cap index, the index is called Chinext, is trading at 80 plus times. US mid-cap index is Russell 2000, quoting at 45 times. Again, as high as possible except for the 2007-8 bubble. The rest of the market is not so absurdly priced. But it is not my idea to tell you whether these valuations are right or wrong. My idea today is to share with you that whoever is taking policy decisions is looking at some global crisis waiting to happen. Commodity prices cracked. It was a big boon for India. US high yield debt has gone up like there is no tomorrow. US high yield debt has actually delivered returns of 30 to 40% per annum. One year. Yeah. Yes. The US dollar has been strengthening. German bunds have fallen from 3.5% to almost zero and back up to 100 basis points. Now, it doesn't sound much, but 0% yield going to 100 basis points on a 10-year German bund is a big hit. It's a hit in excess of 10%. 10% in a German bund, where you are hoping to earn 1% per annum, means you've foregone 10 years of interest. And this is assuming you were not levered. If you were levered, then the kind of hit you would have taken on the German bunds would be crazy. US is showing improvement. Housing sales are up, unemployment is down. In the month of May, 5.4 million job listings in America, which is the highest in the last 15 years. This is jobs advertised. Highest in the last 15 years. Europe actually showing signs of recovery, coming out of the negative growth. US household debt has corrected significantly. However, all this good news is actually bad news. We are in a perverse situation. And why is that? Because we are on steroids. The steroids will continue so long as we have bad news. So, in many ways, the way the world is looking at it is bad news is good news. But when bad news is good news is bad news, right? Because that means steroids are going to be taken away. Now we move to India. Our growth is actually now slightly better than that of China as per the new methodology. But I am not able to understand the new methodology. The numbers, the new methodology says that the real GDP growth rate in Q4 was 7.6%. I mean, the corporate earnings don't show that. Anecdotal evidence doesn't show that. Most corporates that we talk to don't say that that is their sense. Real interest rates in India, okay? So this line, the lighter line, that is interest rates adjusted for inflation, interest rates net of inflation. Real interest rates were minor positive, went into negative and are back. But why did they go into negative? When do real interest rates go down? Either when inflation goes up or rates come down. But negative real interest rates is a means of stimulating the economy. So we went into negative interest rates in response to the global financial crisis and its potential impact. So remember that this is a policy response. Negative real rates. Local currency volatility, which is rupee volatility against the dollar, is close to its lows. However, what is more important is, as compared to other EM currencies, our local currency volatility is the lowest. So India is actually like an oasis of stability amongst emerging markets. Now let's come to yield curve. First I want to take you to this July 2013, which is when we had this huge spike in rates in response to a weakening rupee. Okay? So this was the yield curve. The 1 month yield was close to 11, whereas the 10-year was close to 8.5. But this is not the normal shape of the yield curve. Logically speaking, if you borrow for 1 month, you should pay a lesser rate than if you borrow for 10 years, right? So the normalized yield curve should be like this, right? Upward sloping. But this was a policy response to defend the currency. This policy response was not the policy response of the government of India. This was the policy response of RBI. Okay? Same way that this negative real interest rates was also the policy response of RBI and not the government of India. The government of India did various other things. They increased the fiscal deficit. They gave an excise duty benefit to the automobile industry and a few other industries. They pushed through Narega and so on. So the government response is different. The RBI response is different. Today, the yield curve is flat and has been flat for a long time. An inverted yield curve like the one that we had in July shows that economic growth is going to head south going forward. Okay? A flat yield curve shows that economic growth is going to be flat going forward. The banking system makes losses in an inverted yield curve. The banking system makes profits in a normalized yield curve, which is an upward sloping yield curve. Okay? In a flat yield curve, banking system does not make significant profits. Okay? Now, I want you to think of this equation, that focus only on the top part. Total stimulus in an economy is equal to fiscal stimulus, which is determined by the government, monetary stimulus, which is determined by the central bank, external stimulus, which is determined by the central bank as well as by the external environment. Why do I say that external stimulus is determined by the central bank? Because they control the exchange rate. The real effective exchange rate is in the hands of the central bank. Okay? So, when Kuroda became the governor of Japan, of the Japanese central bank, and decided to move the yen from 78 to 120, that was his call. He influenced the real effective exchange rate of Japan, influenced the competitiveness of the Japanese corporate sector, influenced the composition of fixed income and equity hold assets within the economy. Okay? And lastly, policy stimulus, which is again in the hands of the government. So, broadly speaking, how well the economy is doing is a measure of these four different types of stimulus or the absence of such stimulus. Today, when we are saying that we do not see growth, it means stimulus is missing. I have used color coding here. Our fiscal stimulus is not there. We are actually contracting our fiscal deficit, right? We went from a fiscal deficit to GDP of 4.5% to 4% actual for March 15, and we are going to 3.9% for March 16 as per budget, and as per FRBM, the fiscal responsibility bill, we are going to we should have been at 3.6% for March 16. Jetli said in his budget speech that I am suspending the FRBM for 1 year and we will catch up with it. Okay? So, his target for March 17 has to be 3.6%, which means there is going to be fiscal contraction, no hope of a stimulus there. Our state fiscal deficit is also contracting, and why is that? Because oil prices had gone up. All the states made a lot of money because oil prices had gone up and their fiscal deficits came down. So, even that stimulus was withdrawn. Monetary stimulus, inflation targeting means a tight monetary policy. You not only have to kill inflation, you also have to kill inflation expectations. Does anybody know the inflation expectation rate in the country right now? Yeah. RBI does a survey of multiple households, and that survey they track. Inflation expectations have fallen from 18% to 9.5%. but it is still 9.5%. Since Rajan has come, he has been moving goalposts. We were targeting WPI inflation, then he says no, we should target CPI inflation, then the CPI inflation methodology was changed, right. Then he says current account deficit is too high, then he says fiscal deficit is too high, then he says the quality of the fiscal deficit reduction is bad because you are cutting down on capex and plan expenditure, etc., etc. He has constantly moved the goalpost. Why is he doing that? There is no external stimulus actually. I will show you that the real effective exchange rate is actually at 112 right now, which means the rupee is too strong, we need to depreciate. The real effective exchange rate is an index compiled by RBI, which measures how our exchange rate adjusted for our inflation compares to the exchange rate of all our trading partners adjusted for their inflation. Yeah, maybe. So, the first concept that I wanted you to appreciate was that growth is dependent not just on government, but government as well as the central bank. Okay? Now, we will analyze what the government is doing and what the central bank is doing, right? And then figure out this growth not happening, is it because of the government or because of the central bank or because of both? All the items in red show that we are actually not providing stimulus, we are withdrawing stimulus. So, I shared with you that fiscal stimulus, fiscal deficit reduction is a withdrawal of stimulus. A tight monetary stance is a withdrawal of stimulus. I mentioned two things here, M3 slack and financial system health, and I will elaborate on this going forward. M3 slack conceptually is the monetary growth in the economy. If I have 100 rupees in my pocket, how much can I spend maximum? Sorry? 100. If I have 100 rupees in my pocket, maximum that I can spend is 100. Same way, if the broad money growth in the economy hypothetically is 10%, then what is the maximum nominal GDP growth possible? 10%, right? So, M3 growth in the 90s used to be at 20% plus. Today it is between 10 and 11%, which means a nominal GDP growth of more than 10 to 11% is not possible. And that is at zero slack, which means there is no headroom. If your nominal GDP growth is 10% and if your monetary growth is 12%, then that means there is a 2% headroom, 2% slack, which you are allowing the economy to gear up further. Today, at between 10 to 11% monetary growth, if the inflation is 6% as Mr. Rajan says, then that means we are all set for a 5% real GDP growth, max, assuming zero slack. Okay? But government statistics say that the real GDP growth is 7.6%. and government statistics say that inflation is, for the Jan to March quarter, CPI inflation is 5.5%, which means that our nominal GDP growth should be 13%, which is not possible with the actual M3 growth of between 10 and 11%. It's given by RBI, and that is easily measurable by RBI. They can measure it. It's much more reliable than your GDP growth.
Isn't that obvious when the GDP deflator suddenly falling last month?
GDP deflator is a proxy, but probably the best proxy for measuring inflation. Okay, so I'm covering that part. So I just want you to understand M3 slack, and also M3 itself is derived by two numbers, M1, which is base money, which the central bank controls. Central bank does not control broad money, it only controls base money, M1. Okay? And then the credit multiplier in the economy. But if the financial system health is poor, then credit growth cannot happen. Okay? Therefore, automatically M3 is poor, even if M1 is constant. So let me give you the US example. Why is there no inflation despite the balance sheet expanding and multiplying so much? When the US Federal Reserve balance sheet expands, their equivalent of M1, which they call as M0, which is their base money, expands dramatically, because their multiplier, money multiplier in the economy has been falling. Therefore, there is no inflation. Milton Friedman has said, inflation everywhere is always and always a monetary phenomena. Their M3 is not expanding despite the M1 expanding dramatically, or rather their broad money is not expanding despite the base money expanding dramatically. We are facing a similar situation here. Our M3 is not expanding, and in any case RBI is ensuring that our M1 is not expanding. So there is no room for growth to exceed 5% if the CPI number is right. External stimulus, I already told you, because Rajan wants stability of because the RBI wants stability of the rupee against the dollar, we are actually now too strong. To maintain competitiveness, we need to depreciate. Our exports are having negative growth. Policy stimulus is stuck, so I have put amber. It's not as if there is zero policy improvement, but it's not all that great either. Then we come to capex cycle, then productivity improvement. All the factors of capex cycle are also in red, and I will show you that. Productivity improvement, again ICOR, which is incremental capital output ratio, which is to improve your GDP by 1 rupee, how much of capital is required. Okay? So the lower the ICOR, the better. ICOR is bad. Consumption. I will show you rural income is in a bad shape, and therefore that cannot be the driver for our consumption growth. Urban income is in a good shape, that could be the driver for consumption growth. So overall, you see predominance of red. Is everybody with me so far? Okay. So now actual data of whatever we talked about in the previous slide. Fiscal deficit down, state deficit also coming down. M3 slack is almost not there. real effective exchange rate is at 112. This is what you were talking about. So, conceptually nominal GDP growth minus, actually not minus, nominal GDP growth divided by real GDP growth should give you the inflation. However, as a thumb rule, the simpler way to do it is nominal GDP growth minus real GDP growth to be the GDP deflator. When you measure WPI or CPI, you assume a certain basket of goods and services and assign some weights to each of those goods and services, saying that we believe that this is a good proxy of the economy, and then track prices for that with those weights and measure the inflation. However, the best way of actually counting inflation is the GDP deflator, because that is the real GDP, right, conceptually. The problem with GDP deflator is that data is available only once a quarter, but CPI and WPI is available once a month. Earlier it was available weekly. They start by computing nominal growth and then they compute the real growth, and the difference between the two is the GDP deflator. Yeah. So, M3 slack is the growth in broad money minus nominal GDP growth. So, what this shows is there is no headroom for growth. Like in April 09, there was so much headroom for growth.
That would depend on how quickly the government is cutting.
Yeah, but that would be only M1.
Oh, sorry, yeah, correct.
Right?
This is credit growth.
Both M1 growth multiplied by credit growth. So, if I take you back to June 2012, on the face of it, what is the GDP deflator? A little over 12 minus a little over 4, 8%. Okay? And that was the inflation then. If I take you to September 2013, here you are at between 7 and 8, and here you are at between 14 and 15. So, the inflation then was 7% as per GDP deflator, whereas as per CPI it was 8%. But what is the picture today? Sorry? Nominal GDP growth is 7.8%, real GDP growth is 7.6%, GDP deflator is 0.2%. There is no inflation. It is not that Mr. Rajan does not understand this, it is not that RBI does not understand this. They know fully well and understand fully well that there is no inflation. Sorry? WPI is in negative, yes. But according to them, WPI is not a good measure anymore, though we had that as the only measure for 45 years. Okay? No, conceptually WPI is not used as the measure of inflation for inflation targeting by any central bank anywhere in the world. We were doing it because our methodology for measuring consumer price inflation was so bad that you could only target WPI. That was the only decent number you had. Let us look at other factors. Non-food credit growth, all down. But this 8.9% is very misleading. This is amongst the lowest in the last 30 years, okay? Non-food credit growth of 8.9%, lowest in 30 years. But it is misleading because credit growth to industry is growing at only 5%. Only 5%. ICOR, before they changed the GDP methodology, ICOR had gone from a little over 4 to a little over 8. 8 is a very bad ICOR. India used to be much better. China is also closer to 7 and 8. And they are in a bad place right now. But after the new methodology of calculating GDP, our ICOR is now back to 4. Now, why is that? Because our savings rate is still close to 30% of the GDP. Okay? But they say that GDP is growing at 7.6% in real terms. So, 30% and 7.6% gives you 4. That is our ICOR. But it is my contention that that GDP computation is wrong. We are not growing at 7.5%. We are actually growing at 5% or below, and our ICOR therefore is more than 6. This is the capacity utilization that RBI measures. This is with a very significant delay. So, the latest number available today is Q2 of FY15. Okay? But even then, we were at 71%, and this low was 69%, which is the lowest low since 1990. 69%. This is RBI data. Capital formation constantly going down. We are very happy that our current account deficit to GDP is coming down. We say that it is because oil prices have come down, but that is only one way of looking at current account deficit. The other side of the equation is current account deficit is equal to savings minus investments. Okay? So, the gap between savings and investment is coming down, which means we are not investing enough. So, irrespective of the oil price, if we start investing dramatically tomorrow, our current account deficit will go up. But as of now, our current account deficit is down because our investment to GDP has fallen from 34% to 2%, to 29-30%. Okay? All okay so far? This is why the capex cycle cannot take off. Who will set up capacity if your existing utilization is below 70%? Even if you want to set up capacity, who will set up capacity if your ICOR is so high? It is not economically viable. An ICOR of 6 plus means that you are not viable at all if your interest rates are 11-12%, which it would be for most Indian borrowers, right?
How do we improve our ICOR numbers?
So, ICOR is a derived number.
Savings into
No,
GDP.
no, the reverse way. Savings percentage of GDP divided by real GDP growth rate. Okay. So, if we are to improve ICOR, our GDP growth rate has to go up, or investments as a percentage of GDP, no, not savings, investments as a percentage of GDP has to come down. Investments, it is investment, equation is investments to GDP divided by real GDP growth rate. Investment as a percentage of GDP divided by real GDP growth rate. Okay. Yeah, I'll explain to you. So, if your ICOR is 6, which means to get 1 rupee of value add in the economy, because GDP is value add, right? 1 rupee of value add, I need to put in capital of 6 rupees, right? But what is my cost of capital of 6 rupees at 12%? 72%, right? So, 1 rupee of value add, not profits, 1 rupee of value add minus 72 paise of cost of capital leaves only 28 paise, which is not enough to cover my other costs. If my non value added costs are less than 28%, then I will have profits. No, I am looking at from a person who is deploying capex, which is why I am saying that the capex cycle is not starting, because me as a person who is deploying capex, for me the cost of capital is 12%. Okay. Now, let us forget the investment part of the GDP, let us come to the consumption part of the GDP. Rural income. Why was consumption growing beautifully a few years ago? Because we were raising MSP prices dramatically. But today wheat price in India is equal to or greater than wheat price in US. There is no more scope to push up prices. In any case, global commodities and especially agri commodities are in a bad shape. They have corrected a lot. So, you will see that this year our MSP hikes have been flat, very low. During some years of the UPA government, we have given MSP price hikes of as much as 20%. And Narega. This is what Narega did to rural wage growth, and this is what generated this huge consumption boom. And this is why all the consumer companies are quoting at very fancy multiples, because that is the only part of the economy which was growing. So, it is a quest for growth, it is a flight to growth, but Narega spends have tapered off, rural wage growth has come down, and MSP hikes are much lower than inflation now. So, going forward inflation will not be there or will be substantially lower. Various studies have shown that the highest correlation of inflation, CPI inflation as we are measuring it today, is to two factors: MSP hikes and rural wage growth. In fact, who's the guy from Oxus? Surjit Balla. Surjit Balla has gone on record saying that RBI knows better than anybody in the country that these are the two factors which have the highest correlation, and they explain 99% of all inflation over the last 10 years. Only these two factors. And he says that has been addressed. So, why is RBI still stuck? MSP hikes and rural wage growth. Okay. Now let us come to urban consumption. This is the jobs peak index. If you see year on year, it is showing a very good growth after a long time. Jobs peak index. This is compiled by Naukri.com. In India, we measure our unemployment rate once in a few years. 9.5% is our official unemployment rate. In the US, they did TARP, they did QE, they did everything. They went to zero rates because their unemployment rate came close to 9%. We've been at more than 9.5%, at 9% plus for many years and decades now, but nobody is bothered. RBI has no mandate to tackle unemployment. It could, but we will know after a few years because it is not measured. The US Federal Reserve has a dual mandate: inflation and unemployment. That's the only data available, which is why I said urban. I'm using it for urban. Pay commissions. Every time that we have a pay commission, there's a huge spike, as much as 20-25,000 crore per annum. Remember that Narega is 40-45,000 crore per annum. Okay. So whenever we have a pay commission boost, you will see a consumption boost in urban areas. Pardon? No, the next commission is coming up. 6th pay commission has happened, the next one is coming up. Okay. So urban consumption stories from a top down perspective would be the place to be. This is a government mandated commission which announces a pay hike once every 5 years or so. It resets everybody's pay. It's not a regular hike. In the public sector, sorry. Yeah, because if it was supposed to be done at the end, in 5 years, but the pay commission ended up doing it in 6.5 years, then they pay arrears for the 1.5 years. Absolutely. It does, but much more in urban areas than in rural. As salaries go up of the government employees, automatically it raises the pool, or raises the table of salary levels in the economy. Like what happened in Narega. When they started Narega, it raised the rural wage growth, although that farm labourer might not be employed by the government, but because he had a higher priced alternative, the salary table goes up. Same way in the urban areas, right? Sorry? I don't know, I am not on the commission. The 6th pay commission was 22%. I have no idea what its impact is. Modi says its impact is much higher than what he expected. So, I have no idea. Right. Yes. 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 So, those are factors which will only improve the urban income determinants. So, which is why I am saying that urban income plays are the best place to be. Okay? Not as much, because our CPI is very high, has a very high weightage on food. Okay. So, this is CPI and WPI. WPI is minus 3%, CPI is 5.1% now. However, apart from inflation, these are some lead indicators which both RBI and government track. One is consumer confidence and one is business expectation. Okay. Both are showing an uptrend. I was telling you I will talk about the financial conditions index in India. Here is the financial conditions index. Now, this is not computed by Bloomberg. We use a methodology which is similar to the Bloomberg methodology and create this index in India. So, we seem to be, before this latest bout of correction, in a fairly good shape, but with the yields backing up and with the markets also correcting, you will find that this would also have turned down slightly. In sum, what I am trying to say is that as an entrepreneur, there is not much excitement to be doing capex right now. The private sector is not going to do capex. Some other indicators, monsoon, non-food credit we talked about, this is M1 and M3, and lending capacity. I want to focus on lending capacity. Lending capacity is measured by what is known as credit deposit ratio, but actually you measure it in two different ways. One is the credit deposit ratio and second is incremental credit deposit ratio. So, if you see, our credit deposit ratio is quite close to where it has always been, that is the flattish line here, despite the fact that RBI has reduced SLR ratios, RBI has reduced CRR ratios. At one point of time, SLR plus CRR was more than 30%. Today, SLR plus CRR is about 28%. So, which allows far greater room, and therefore, our credit deposit ratio should actually move up by at least 200 to 300 basis points. But what is happening? Our incremental credit deposit ratio is actually going down, despite the fact that we have room to have an incremental credit deposit ratio of more than 90%, because we are our banks are sitting on excess SLR. We have room to have more than 90% incremental credit deposit ratio for at least 2 to 3 years. We are at about 29%, 28-29% of balance sheet, whereas we are required to be at 24. Okay. So, we have a lot of lending capacity, but we are not lending. Because we are not lending, our M3 is not growing. And what does Rajan say to this, or what does RBI say to this? RBI says that there is no credit demand in the economy, and because there is no credit demand, it does not help whether or not I am cutting interest rates. But the point is that in the US we have had exactly the same situation since 2008. There is no credit demand, everybody is delevering. See, when inflation is high, it favors the borrower, right? Does everybody get that? Okay. When inflation is at 0.2%, which is the GDP deflator, which I think is the true measure of inflation, there is no incentive. Yes. He is saying I have already reduced it by 75 basis points, there is no growth. That is their answer. He is saying I have cut by 75 basis points and it is not leading to.
At current interest rates. And one of the reasons is the incremental interest rate. Maybe if it's lower, some things become positive. But then there are other things also, there are other bottlenecks in the economy, which is, I mean, people will make money if there's money to be made, right? We have to assume that businessmen are being a bit rational.
That's exactly. So that is exactly what RBI is saying, that people are not taking credit because there is not money to be made in the economy.
Is that his way of telling the government to do something?
Yeah. That is his way of, he's been telling the government to do multiple things over the last 3 years.
Question, and maybe you're going to come to it later on, but it feeds into the context of all of this. In 2008-9, took some external and monetary measures, which was the RBI, and the government took fiscal measures, for example,
Right.
excising
Perfect.
tax and these things.
So we are both coming together.
They were working together. What is your assessment of what's happening?
They are not working in the same direction. One is pushing, one is pulling,
Why?
which is why we are not moving.
Why and how is that getting fixed?
It is not getting fixed anytime soon. So one must understand why one is pushing is understandable, right? Why the other one is pulling is what is the question, and that is what we need to understand.
Just like if this world is in a deleveraging mode, so the argument given by RBI in the context of like we already have a utilization levels of less than 70%. Does it not make sense also? Like it's right that there are not enough. So like which side of the argument is right?
It's difficult to say at this point of time, but all I can tell you is that for recovery to happen is going to take a long time. I think Ravi was there at that the C Institute presentation, right? I gave the same data there, if you recollect, I don't know if you recollect, and said that growth is not happening anytime soon. And I say the same thing again, growth is not happening anytime soon. The lead time on all of this is very long. If the government spends, the fiscal deficit widens. They can't have that. They have to actually contract fiscal deficit. So government can't spend. Yeah, but that's there is a lag effect, no? You have to spend first. The GDP comes later.
So that means the entire capex cycle needs to be government can use public sector banks. They are sitting on a lot of cash. Suppose India and NB. They can use maybe these entities to start the cycle going.
Yeah, it could. But in the context of the economy, it is not large enough.
Yeah, capacity utilization is low.
And PSU banks, I will come back to later.
We know that there is less demand for putting up new projects, but those kind of people are worried about long-term rates. Short-term rates themselves are too high.
No, short-term rates are not too high.
But if short-term rates came down further, could at least
Then you would actually have a normalized yield curve.
right.
If short-term rates come down, you will have a normal yield curve.
Start a better working capital cycle for many small businesses who are probably borrowing at 18 to 20%.
Yeah, it could. But the commodity crack also is eliminating demand for working capital funds. If I am holding 100 tons of steel in inventory and steel prices come down by 40%, I need to fund that much less, right?
It could be a vague statement, but I
No, I don't think so. Anyway, yeah.
Will the government be waiting to widen the tax net and use that excess cash to start spending on some chicken and egg situation?
I object, Lord.
We are actually talking of reducing rates. Jaitley has committed in the budget.
No, because of all these measures to curb illicit farming.
Yeah. So what is happening is the white economy in any case is not growing, and all these measures will actually contract the black economy, right? So that is actually also exacerbating the economic contraction. All right. So why are we not lending? Here, this is deposit growth and credit growth. As you can see, the darker line is the deposit growth. Our deposit growth is higher than our credit growth. So even on an incremental basis, we are not able to deploy the funds which are coming into the banking system, and that is compromising growth. Look at the correlation between bank credit growth and nominal GDP growth. Sorry? There is no established relationship there, but there is a high correlation between the two. That multiplier that you are talking about is actually M3 divided by M1. That is 3 today. M3 divided by M1. It was not much better actually. It was around the same, because we had a very high statutory liquidity ratio and CRR ratio. Unlike the US, where the multiplier has shrunk dramatically, in India it has shrunk only a little, because we were bad to begin with. In between it had fallen to 2.7, 2.8, but we are now at 3. Okay. Also the credit mix. We are looking at aggregate credit growth. Look at the mix. Personal loans is the fastest growing component of credit. This is all consumption money. Credit to industry is has the least growth. Also credit to services, which means that the growth rates of services and industry should be converging. The credit data is showing that, but the government data is not showing that. Consumption items. It would, but consumer goods is a very small fraction of the total GDP. I have data on gold a little ahead. Sorry? Maybe, maybe. And now let me show you why we are not lending. Although we have the lending capacity, we are not lending. This is the reason. Non-performing assets plus restructured assets for the public sector banking system, which is 70% of the total banking system, is north of 12% on an average. There are some which are, OBC for example is close to 20%. Okay. Now what does it imply? NPA plus restructured assets, we can say, we can keep debating that it has wiped out the capital, etc., etc. But I want you to first understand the P&L impact. If it is, let us say 12%, NPA plus restructured assets is 12%, which is the present average. It is between 12 and 15 somewhere. Let us take 12%. the net interest margins of the PSU banking system is close to 3%. Cost to income ratio is close to 50%, which means costs are 1.5%. Okay? Which means net interest margin minus cost is equal to pre-provision profits, which is equal to 1.5%. Okay? But this is P&L. What is it on cash basis? On this 12% of NPA plus restructured assets, you are not getting any interest in cash. Okay? Assuming that the average interest rate is also 12%, it means 1.44% of your NIM, right? So 1.44 out of 3 is not coming to you in cash, but your cost is in cash. So if you do 3 minus 1.44 as the net cash NIM, right, that is 1.56 minus 1.5% as cash cost, leaves you with 0.06% of pre-provision profit, pre-provision cash profit. The banking system is not making money. They are not making money on lending, they are not making money on treasury. 12% of NPA plus restructured assets, which are the accounts which are not paying interest, at the rate of 12% interest rate. Okay? So the PSU banking system is not in a position to lend. Do we have a handle on why lending is not happening now, despite having the lending capacity? I am not even getting into the fact that our capital adequacy ratios of the PSU banking system are so bad that even if it was profitable, they can't lend. All right. So M3 is not expanding in a hurry, come what may, no matter what anybody does. Okay, this is the incremental bad loan ratio. The yellow line is the latest year. Everywhere you can see that the yellow line is the highest. So incremental NPAs are high.
What do you think for them 20% of the restructured NPA book for that to recover? Banking should start, that has to improve.
Before it recovers, it will worsen, for sure.
Actually will increase.
Definitely. Overall debt servicing metrics of corporate India remain poor. Number of companies with interest coverage ratio less than 1 is 17%, and with interest coverage ratio of less than 2 is 38%. This is Moody's data. 33% is, yeah. This interest coverage ratio, number of companies? I don't remember that, sorry, but it was
high and then it went down.
yeah, because our profits to GDP was high, no? You remember the first slide? At that time our profits to GDP was high.
I know it's not related, just curious. Do you know what is the situation of the lower graph in China? Are they worse than us?
They would be, is my guess. Okay. So our public sector banking system requires a ton of capital, irrespective of whether there is demand for credit or not. They need a ton of capital to survive, because in that computation which I gave you of 12% NPA plus restructured assets at the rate of 12% being 1.44, if that 12% goes to 15%, you are incurring cash losses. So this is the assessment of capital requirement. For FY17, we need about 1,30,000 crores. For FY18, we need about 1,60,000 crores. and for FY19 we need a 2,40,000 crores. Pardon? Incremental. No, incremental. This is the incremental capital requirement.
Assuming current rate growth.
No, I will show you that as well. We are also deploying Basel III and our NPAs and the restructured assets which are getting converted into or which will get converted into NPAs will give you this. Sorry? Yeah. It's a global, no. We've already deferred it. Yeah, but that is an admission that my banking system is in deep shit. Right? So, if you just add up these three numbers, you are talking of a number which is close to 5 lakh crores in 3 years' time. Now, out of this 5 lakh crores, now this is even more interesting. You see the mix. You need so much of equity. The green bar, that much of equity you need. You cannot substitute it. The AT1 is the additional tier 1 capital, which is typically in the form of bonds. So far, about 7 to 8,000 crores of AT1 bonds have been issued. But now, their yields are showing that no more AT1 can be absorbed by the market. So, for all practical purposes, this AT1 will also need to be capital. IRDA has not approved AT1 bonds. EPFO has put conditions on AT1 bonds which are very onerous, additional tier 1 bonds, which are bonds with a condition that they will get converted into equity if certain ratios of that bank, of the issuing bank, fall below a particular threshold. Absolutely.
All these equity will be issued at 0.6, 0.7 times book.
0.4 now. But no, so what I am trying to tell you is AT1 bonds are not going to happen, because if they pay 11% on AT1 bonds, in any case they are not going to make the 3% net interest margin. In any case they are going to be negative. So, it does not make sense to do AT1 bonds. So, this also will need to be capital, and then we come to tier 2 bonds. Okay. The market is not deep enough to absorb this much of tier 2 bonds. The market is not deep enough to absorb even half of this much tier 2 bonds. If you look at the statistics of the last 10 years tier 2 bond issuances, the market cannot absorb even half of this. So, effectively what I am saying is 80 to 90% of this capital requirement will have to be equity. Yes, but if government issues a 2 lakh crore check, what is going to happen to our fiscal deficit? And if that is going to happen to our fiscal deficit, Rajan is going to throw a fit. He is going to throw a bigger fit. Yes, but the government stake cannot come down below 50%, right? So, but the government cannot give because the fiscal deficit is a constraint. Absolutely. They just can't do. Absolutely, it's too horrifying. It's the only solution. Sell it to private.
There is no other solution. There is no other solution. It's going to buy it so bad. Somebody can get some price to take value out of it. Political will and
It's not going to be haircuts. It's going to be head cuts.
No, but these banks, would have great real estate franchises, great custody. It can be monetized by a private player, perhaps.
Yes.
Basically, what you're saying, what US did in 2009, they're going to do in 2012.
But they were willing to take the fiscal deficit expansion. They did a TARP of $800 billion, which pushed their fiscal deficit to GDP to 8%. And they said, we don't care, we'll do it. And the central bank said, unlimited balance sheet, whatever it takes. In India, neither the government nor the central bank is going to do that.
Utpal, and even if they did it, we'll have another round of NPA 5 years from now. So it's no point.
NPAs to be addressed.
Yes.
Private sector banks in India are absolutely clean. All these dirt and everything is there.
They are not absolutely clean, but their NPAs are very manageable. Yeah. There is no problem there. And they are all quoting at multiples of book, so they can raise capital. They have raised capital.
So this demand is combined for public sector plus private, right?
Yes, it is.
What's the breakup?
It's 90% plus is public.
Capital requirement.
Yeah. Okay. Let's move on a little bit.
Around 8 lakh crores, CWIP,
Hmm.
dropped into power sector. Is there any hope of some cash flow coming, let's say, a year, 2 years down the line, back to the banking system? If the power plant starts, the fuel starts, 30% gas leakages start, there's some reverse.
But you are looking at only from the generation angle. Out of 8 lakh crores, between 3 to 4 lakh crores is transmission and distribution. Distribution is in the doghouse. So there is no solution to distribution, and that data is here. The bank credit to power sector is 10% of non-food bank credit. 10% is power sector exposure of banks. Yeah, about that. So 10% is, no, non-food credit is, total is about 80 lakh crores, and 10% of that is 8 lakh crores. It tallies, right? Sorry? Non-food credit. Yeah, because food credit is not computed by banking system. Meaning it's treated separately. Pardon? You can sell real estate, but developers are not able to sell their flats. Where are so many banks going to sell so much of land? And who's going to buy? Which developer is going to buy land? Each developer is in deep shit anyways. Sorry? BSNL itself is making losses. Assets are good, but who will buy? It's an option. But it's but it's too small in the context of what is required.
The message from the government has been clearly that, with regard to capitalization of PSU banks, their intent is clearly on the negative side. So, can there be a case of,
They don't have a choice. They have to do it. Either that,
or they let it die?
well, if that dies, the economy is dying.
Why was the provision for the bank recap so low in the budget? Forget the FS, like the financial.
Yeah, because I don't think they.
Know this problem.
I don't think they understood the problem fully.
So who's the bigger culprit?
Your choice. I am giving you all the inputs. You decide. Let's move on. This is the composition. This is the mix of credit. Okay? Is it visible? Okay, this is agriculture. That's about 7.9% of GDP and 13% of the banking system credit. Okay? This is manufacturing, that's around 40 odd percent of banking system and about 25% of GDP. Then services and then retail credit. So you will see that the CAGR is highest for retail credit, and there are some segments which is the medium manufacturing units which is having minus 16%. Okay? You will see more and more elements going into red. One, because they are not able to lend. Two, those guys are getting into NPAs. And three, we don't have the credit assessment mechanisms. The lending standards are being tightened, and they are being tightened so much that the system cannot take credit with those lending standards. This is the forecast of how much they can grow. Okay? This is the forecast of how much each bank can grow over the next few years. The highest is 7 to 8%. And if you apply the criteria which the government has set out, except for one or two PSU banks, none of the banks will be eligible for any capital infusion. Okay. Now, these are all statistics that we were getting from RBI. We did our own analysis, which we call as the Z-score analytics. Yes, Altman's Z-score. We applied this only to BSE 500 companies, excluded all financial and bank companies. That left us with about 416 companies. 22% of these companies are in distress as per Z-score, which means a very high probability of defaulting within the next 2 years. Okay? The average debt of these distressed companies is 13,110 crores per company. There are 93 companies which are in this distress zone. 93 into 13,110 will give you a number which is close to 13 lakh crores. 13 lakh crores only out of these 93 companies, which have a very high probability of defaulting in the next 2 years. Today, out of the 80 lakh crores of credit by the banking system, we are saying 12% is NPA plus restructured assets, which means about 9.6 lakh crores. According to this, only the top 93 companies which are in distress accounts for 13 lakh crores. You can extrapolate to the rest of the economy. It's coming. I'll give it to you. So actually the Z-score had started improving, but now has started worsening. And this is only data up to September 14. I can assure you that the latest data will be worse. We talked about, sorry? We have the sectoral breakup. It is infrastructure, power, metals, all of it. There are some sectors which have shown improvement, like textiles. Okay. So we said that we are going from a negative real interest rate scenario to a positive real interest rate scenario. But what is the impact of this at an economy level? Leave aside the cost, leave aside its impact on demand. What does it do to savings? What it does is changes the mix of savings. Today, 52% of India's savings, household savings, are in physical assets, which is real estate and gold. 48% are in various financial assets. Okay, this is not true in most of the developed world. It's actually the other way around. Much more. Financial assets would be 70% of savings, household savings in the US. So as you can see, this is gold demand and this is real estate prices. Both are already showing the impact. However, it takes time for savings to move from the from the physical assets to financial assets, and only after they move into financial assets will they start becoming more productive. But that assumes that the transmission channel is in place. Our problem is our transmission channel is not in place. Therefore, even as savings are moving from physical assets to financial assets, we are not able to push them to productive use because of our broken banking system. We have no choice but to set our financial system right. This positive real interest rate is what is driving a lot of demand for Indian debt from abroad. So I want you to watch this.
गुड मॉर्निंग। आप लोग सब मिलकर मुझे पीटने वाले तो नहीं है ना? मेरा साहब मारना मत यार प्लीज। मानता हूं कि मैंने काम पिटने वाला ही किया है, बिना बताए चला गया। पहले से ही कंपनी की हालत इतनी खराब थी, ऊपर से मैं और मेरी तन्हाई। मैं ये भी जानता हूं कि मार्केट में मेरे बारे में कई तरह की बातें चल रही। आदित्य कश्यप अपने फादर की जगह नहीं ले सकता, कंपनी स्प्लिट होने वाली है, उसकी गर्लफ्रेंड ने किसी और से शादी कर ली है, वो शहर छोड़कर भाग गया है, वगैरह वगैरह वगैरह। झूठी अफवाहें जो बाय द वे सब सच है। सो हमारे शेयर प्राइसेस ऑल टाइम लो पर हैं, सारे नए ब्रांड्स फ्लॉप हो चुके हैं, ऊपर से 572 क्लेम्स। इन अदर वर्ड्स अपनी हालत बहुत खराब है बॉस। साडी तो बैंड बच चुकी है, इससे बुरा और कुछ हो ही नहीं सकता। अब सिर्फ अच्छा हो सकता है और होगा। इंसान जो कुछ रियली चाहता है ना, एक्चुअली उसे हमेशा वही मिलता है। और इस बार मैं रियल में चाहता हूं, एक्चुअल में, कि हर प्रॉब्लम को सामने से फेस करूं, हर इनकंप्लीट प्लान को कंप्लीट करूं, इस कंपनी को वहां तक ले जाऊं जहां खुद डैड भी नहीं सोच सकते। मैं जानता हूं कि आप सब डैड से बहुत प्यार करते हैं, वो हैं कहीं पर, देख रहे हैं हम। तो चलिए उनको दिखा देते हैं कि बॉस ज्यादा भाव खाने की जरूरत नहीं है, ये कंपनी आपके बिना भी चल सकती है और आपके एक्सपेक्टेशन से बेटर चल सकती है। दिखा देते हैं। What do you say?
Whose? Whose? You tell me? Okay. So these are the things today on your radar. Globally, risk of US interest rate lift-off, dollar strength, high yield exuberance, Grexit, sovereign scare, China hard landing, China market mania, Japan JGB risk. JGB is Japanese gilt bonds. They're sovereign securities. The 30-year JGB is quoting at 0.25%. Their inflation is predicted to be 2%. The central bank governor says we will make it 2% if it is not 2%. But your 30-year JGB is 0.25%. It cannot sustain. EM currency and flows challenges. Between 2007 and 2013, emerging market countries have borrowed between 700 and 900 billion dollars of dollar denominated debt, which they have to repay beginning 2015 up to 2018. There is going to be trouble there. Competitive devaluations. Japan devalued by 40%, the euro devalued by 30%. What do you think? India depreciated by more than 20%, and we still need to depreciate more. What are the issues on your radar in India? Financial system risk, rupee depreciation, M3 growth, interest rates, and government spending kickstart. Actually speaking, if these 5 things are done today, then you know that the healing process is on. Then we are on the right path. The day this happens, all your concerns about growth should go. Then it's only a matter of time. It is not if, it is only when. Right now it is if. What if GST and land acquisition bills don't pass? Then there is policy frustration. Monsoon is a risk, global contagion impact. But I don't think the picture is as bleak as I've made it out to be. We are in the midst of a structural change. Every structural change induces a lot of pain. We are going through that pain. And let me actually play the story out for you. The first round of liberalization, which began in 1991, it was an economic liberalization program. We brought down tariffs, we depreciated the currency, or rather devalued the currency. We improved our competitiveness, and this forced everybody to become operationally far more efficient. That process started in 1991, continued till probably 99-2000. Today most Indian companies are operationally benchmarked to the best in the world. Enhanced competitiveness, capacity creation, foreign flows driving investments, foreign markets access opened, but we still had volatile exchange rate and inflation because we had not set right those parameters. We were vulnerable to the Asian crisis in 1997, the Russian crisis in 1998, the long-term capital crisis in 1999, the 2001 internet bubble burst, everything. We had negative real interest rates. Not as they were measured then, because at that time we were measuring it with WPI. But if you take the CPI numbers for industrial workers, which was calculated then, but never used by RBI, we were in negative real interest rates. Urbanization, no social protection. IT and telecom sectors were the key catalysts. Many low-hanging fruits, very low base effect, but there was still crony capitalism and corruption, and Sensex was at 600. it took a long time, the first round of liberalization. Look upon this as the second round of liberalization. This is governance liberalization. This will drive capital efficiency. What is happening to the banking system today will bring back respect for capital. Like what happened to equity markets has brought back respect for capital with regard to equity, this will bring back respect for capital with regard to debt. Until now, debt was to be taken and never to be repaid. This will lead to enhanced capital productivity. Capability creation as distinct from capacity creation. Domestic flows will drive investments. Not that foreign investments will not be there. It's just that our dependence on foreign investments will keep coming down. Our current account deficits are low. Our government debt to GDP is low. Our total debt to GDP is low. Our external debt to GDP is low. One global market. We no longer have to fight for access to global markets. Stable exchange rate and inflation scenario for years to come. This is not a cyclical thing. This is a structural thing. Positive real interest rate. Rural and urban demand opportunity. The positive real interest rate will move savings into financial assets which will become productive in the economy. With social protection, direct benefit transfer, Jan Dhan, Jan Suraksha and all of that. Mobile and payments will be key catalysts here. Better scalability of infrastructure. We have far better infrastructure now than we had in 1991, but we have not scaled that infrastructure. We are not utilizing it well enough. We still have a long way to go on infrastructure. It is imperative that structural change has to happen in economy, it has to happen at companies level, it has to happen in each of our individual minds. The way that we do business has changed and is changing. The corruption, crony capitalism business model of profits is broken. So we are seeing a big one-time correction there. But this will lead to far better quality of profits going forward. All these factors will lead to a much more sustainable cycle, and the down ticks in the cycle will be much lesser, and the viciousness of the down ticks in the cycles will be much lesser. We are at a takeoff stage in many ways if we can address these issues. Also, instead of crony capitalism and corruption, we will have hopefully a strict and a fair framework. Today, Sensex is 26,000. This is something like what happened in the US between 1980 and 2015. I don't know if people remember. This was the combination of Ronald Reagan and Paul Volcker, right? Exactly the same. You also had a financial crisis there. I don't know if anybody remembers. Savings and loan crisis. Yes. Big 84. Savings and loan crisis was 84. Okay. 1987 there was a crash. Yeah, periodically. Okay. Now, US 10-year bonds were at 14% in 1980. It is at 2.4% now after a bottom of 1.8. Is it something like that? Is the question to be asked. Is it creating the base for a 35-year bull market? we have the highest real rates right now that we've ever had in India's history. If you apply the traditional measure of repo rate minus WPI, which we've been doing since independence, and if you continue the same measure today, repo rate minus WPI is the highest ever. Lowest M3 growth ever. We have data for 30 years, this is the lowest in 30 years, except for 1 month in 2008-9. Highest forex reserves in our history. Improved current account deficit, better quality of fiscal deficit, inflation targeting and positive real rate, lowest corporate profit to GDP, capex cycle at a trough, black money corruption on the run, oil and fertilizer subsidies on the wane, UID, Jan Dhan, Jan Suraksha, etc. Dedicated freight corridor. They should become a reality in 17-18. What are the other things that can happen? 51% in multi-brand retail. The insurance 49% has already happened. Power sector cleansing, SCB solution. PSU bank recapitalization. The government can issue recapitalization bonds. Okay. So it gives the money to the banking system as equity and takes back the money as recapitalization bonds. No, from the same bank. What it does is changes the capital structure of the banking system, or create a bad bank. Lower marginal tax rates already promised by the FM. GST, land acquisition bill, Delhi Mumbai industrial corridor, 100 smart cities, Make in India, Swachh Bharat, Digital India, all of these can happen. If they happen, we are in fabulous shape. What does this mean? Lower vulnerability to global turmoil, domestic economic cycle trough, slow growth but sustainable growth, scope for monetary easing, corporate earnings to rebound, domestic savings revival, a social security net, and financial system resilience. We are today cleansing the sins of decades in the financial system. All these NPAs are not necessarily NPAs of today, right? These are a lot of zombie assets which have been there for many years. We are cleansing everything. Sorry? So that is it.